cool. So again, like I said, my name is Jason Love, and my presentation here today is going to be the day trading holy grail. It really does exist. And if you've been trading for any length of time, you've already started rolling your eyes going, okay, I've heard that it doesn't. And we'll talk about what I mean when I say that the day trading holy grail really does exist. And so again, let's get started here this afternoon. Again, I've got about 45 minutes. We'll try to take some questions at the end. I know it's been a long day. And again, like I said, I appreciate everyone's attendance here today. And let's get started. My goal here today is to show you how to become a consistently successful trader without using complex trading tools or even having a high win percentage. So my objective here today is to walk through our process that to get you there. So again, like I said, my name is Jason Love. I'm the founder of the Oil Trading Group, and that's me on the left back in when was that? Back in 1988. I just gotten out of Navy boot camp in Chicago, Illinois. And that picture there to the right, directly to the right of that, is me today. Boy, age is an awesome thing, isn't it? And that's me today. So as Renee mentioned, I am a veteran of the U.S. Navy. Once I got out of the Navy, I attended school, got a part-time job as an inbound travel agent to pay for some school. By the time I had finished a 10-year career there, I was the vice president of that same place. So it started out as a online, just your basic entry-level employee, and by the time 10 years had rolled around, I was running that entire place of 300 people. I started trading in 2003. Like I said, it was an inbound travel call center at the end of 9/11. As we all know, that caused a significant hiccup in the travel business, and it was at that point that I was forced to make a decision, do something else or move away. And I wanted to, at that point, I was interested in doing something else. And so I picked up day trading. We'll talk some more about that in just a little while. In 2010, we founded the Oil Trading Group to address, like Renee had mentioned, to address a need that we had in our marketplace. Again, I've been an oil educator for a well-known prop firm. I've had a featured radio show, a daily featured radio show on their Squawk Radio, and then have been a funded trader with this prop firm. In fact, our training program has helped over 24 traders earn more than $2 million in fully funded trading accounts with various prop firms throughout the world. In fact, I'm going to take just a minute here to show you just a couple of things here. I've gotten a few emails where we've had 3 people just recently complete one of those, complete the criteria to become funded. And so we'll pull this up here. This is one person who has gone through, and you can see they've had some really nice trading days here. They are up over $6,000 in their prop firm account as they are going through their process in just about 4 days. And so you'll see the date on this was this, let's see, where was the date on this? Well, let's go back here. We'll come back to this. All right, so you can see that this was as recently as February 7th for this particular person. So congratulations to him. Simon here has been at it just a little bit longer, but you can see that he is just recently, it says congratulations on passing step 2 of his funded trader account. And this was sent to me yesterday as well. And then we had one more that was done here recently, and this was from Gary, who again, you can see this was all the way up to February 6th, is at 3,100, and all he has to do is wait his 10 days, and he will have a fully funded trading account. And so again, these are just examples of folks that have gone through the process with what I'm about to teach here to you today. And we will talk some more about that as we go through here. All right, so through the course of time, I've done a lot of things right, but I've also done a lot of things wrong. So after doing this, and this meaning running a trade room and being a day trading educator for almost 10 years, trading for more than 10 years, running the day trading chat room for 8 years, I have seen all types of indicators in trading rooms. There are tons of indicators and tons of trading rooms. Some are really good, some are, as you know, not so good. What we also know is that complex tools and indicators are not necessarily better, but what we know for sure is that complexity sells, right? So the more complex as traders, and I'm in part of this group as well, I like to see fancy indicators and things that look cool on my charts and I just like all of those kinds of things, just like everybody else does. But complex indicators aren't always the best thing out there, right? Complexity sells. It's good to sell you things, but it's not necessarily the best approach, right? Because as the markets move, and as we've seen, and I've heard everyone else today talk about the fact that these markets have been extremely aggressive and moving very, very quickly. If you're having to process information very, very quickly, the more complex the tool, the more difficult it is to stay agile and nimble in a fast-moving market. A high win percentage isn't the same thing as being profitable. When I talk to new traders, one of the things that we always talk about is that one of the things that I ask them rather is which one is a better system, the one that wins 90% or the one that wins 10%? And of course, we all know the answer to that question. It depends, right? If you have 9 one-tick winners and you have that 1 11-tick loser, then that's a losing system despite the fact that it's at a 90% win rate. Conversely, if I have 9 one-tick losers and 1 11-tick winner, then that is a winning system despite the fact that it's only profitable 10% of the time. So again, a high win percentage is not the same thing as being profitable. I've learned that losing is part of trading. So you need to have a strategy for the losses. So for those of you that are here today that are part of my chat room, you know that I am from Dallas, Texas, and my favorite football team is the Dallas Cowboys. Back in the day, if you will, and it's been that long ago, early 90s, early to mid 90s, they had a coach that named Jimmy Johnson who won back-to-back Super Bowl championships. He wrote a book that I read that talked about his proclivities for hating to lose, right? And one of the stories that best illustrates this point is they had gone to Washington. They were already in the playoffs, and they were going to have the home field advantage throughout the playoffs, and they were the #1 seed, and everything was good. And they went out there and they kind of laid an egg on that particular day. And when they got on the plane, they were already secure. They had a first-round bye, and they were all playing cards and listening to music and carrying on, laughing, joking, and those kinds of things, right? So Jimmy Johnson gets on board the plane and immediately erupts at the lack of, for lack of a better term, the lack of remorse that people were showing for having a bad game and losing. In fact, he ends up cutting one of the running backs, leaving them only with 1 running back to head into the playoffs, which was a little bit of a risky move given the nature of football, right? The injuries, et cetera, that occur. Anyway, one of the things that Jimmy Johnson talked about is that he hated to lose more than he liked to win, right? So he hated losing more than he liked winning. He would not be a very good trader, right? Because trading and understanding that losing is part of trading, that is part of the process that you go through. So understanding that losing is part of trading, you have to have a strategy for those losses. Also, one of the questions that I ask new potential traders that come to me for the first time is the #1 job. What is the #1 job of a professional trader? And almost invariably, the answer is the #1 job of a professional trader is to make money. And in reality, most every professional trader will tell you that the #1 job of a professional trader is not winning, but rather preserving capital. So saying all of that here today leads me into our discussion. I discovered these things, all of these things that I just laid out for you, the hard way, right? I've been through the wars just like most of you have to get to where I am today. I discovered all these things the hard way, but I've created a blueprint for you to try and get this thing the easy way. All right, what is the hard way? Well, the hard way is spending thousands of dollars on indicators and complex trading information, only to find out later that it may not work. Also, countless hours on and resources on looking for high win percentage setups. So again, if you're on all of these emails that I'm on, one of the common themes that gets you triggered, and again, this is a marketing thing, it is about having a high win percentage, right? This trade system wins 80% of the time. This particular setup is 90% profitable, right? Those kinds of things are eye-popping and catching, but they are really just marketing gimmicks. But what it causes us to do is to spend hours and hours looking for that and resources, looking for those high win percentage setups. I'm going to tell you why that doesn't always necessarily equal success here in just a few minutes. Also, tweaking, modifying, manipulating a trading system after a few losing trades or days. And then once that 2 or 3 day losing system occurs, then you begin to move from trading system to trading system during the inevitable drawdown cycle. and then that cycle repeats, right? You buy an indicator, you think it's going to work, you try to tweak it when it starts to lose, and then you move on after X percentage of time without really understanding the ramifications and the statistical probabilities of a particular system as you are using it. All right, so I'm going to go through some numbers here with you really quickly. And before I do, just want to let you know that the Oil Trading Group does not hold itself out to be commodity trade advisor, and given this representation, all information and material provided here today is for educational purposes and should not be considered specific investment advice. Futures and Forex trading contains substantial risk and is not for every investor. An investor could potentially lose all or more of their initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Having said all of that, I'd encourage you to go to the website, oiltradinggroup.com, to visit the full and get a full comprehensive review of the government required disclaimers. All right, so let's get into the meat of this. We have 3 steps that we use here as our blueprint for success. So if you take a look at that graph to the right, successful trader, that's where we all want to be. We all want to be successful traders. Now, success depends on the individual. Some individuals come to the table and say, well, I don't want to lose. I want to stop losing. I've had a really tough run and I am interested in not losing anymore. And that would be my definition of a successful trader. Another trader may come to the table and say, I want 5% equity growth over the course of X period of time. But whatever it is that you, and however it is that you define success, it needs to be measurable and quantifiable. And again, I think that's something that we can all agree on. I don't think anyone sitting here today would say, you know what, Jason, I'm not that interested in being successful. I think most everybody would agree on that one concept that we all want to be successful. Now, for us, we are developing a trading edge in order to be that successful trader. A lot of people have come on here today and talked about and shown you their specific trading edge, and I'm going to do the same thing here for you today. But in case you don't know, a trading edge is your statistical advantage over the market. What gives you your edge over the market? That is your statistical advantage as you head into trading on a day in and day out basis. Step number 2 is trading strategy. Our strategy to achieve our trading edge is to cut the losing trades short and to let the winning trades run. So again, another area that seems fairly obvious, and I think we would all agree that when we win, we want to win more than it is when we lose, right? So on our winning trades, we want to win more than when we lose on our losing trades, right? And that is the cut the losers short, let the winners run. Again, that's another area that I think we can all agree on. I don't think anyone would argue with me that we all want to be successful traders and that we want to win more when we win than when we lose. All right, step number 3 are your trading tactics, also known as your setups. And we use 3 basic types of trading setups here: price action, decision points, and volume/order flow. We'll talk about those again here in just a moment. All right, so our statistical advantage is displayed here on this TraderView snapshot from end of July of 2017 to October. So again, this is a statistical snapshot of our statistics inside of our TraderView journal, logging journal, and you can see here that we are always trading 2 lots. You can't necessarily see that, but we are always trading 2 lots, and our average winning trade is 2.2 times larger than our winning trade. So if you look here, our average winning trade during this stretch was $432. Our average losing trade was $195. So 432 divided by 195 is 2.2 times risk reward. The other thing that we're doing is we're holding on to our winning trades 4.5 times longer than we are holding on to the losing trade. So the average hold time on a winning trade is about 1 hour, and the average hold time on a losing trade is 13 minutes. So that's, again, about 4.5 times larger. The largest winning trade, which you can see during this window, was $1,700. The largest loss was $340. And again, that largest winning trade is 5 times greater than the largest losing trade. Now, despite losing a break even on 66% of my trades, I averaged a net positive gain of $247 per day on 2 lots. And so again, it is all about cut the losers short and let the winners run. You are going to have a low win percentage. And remember what I told you earlier about the about being comfortable, being uncomfortable, right? You are going to lose a lot when you have small stops. And sometimes those small stops are a little bit annoying because they will come take you out to the tick and then go back in your direction. But again, in the long run, small stops with big targets is the way. That is our statistical edge at this point. Let's dig into these numbers just a little bit deeper. Again, despite a win rate of 34%, we won 62% of the trading days in that window. So we had 56 trading days during that window. 33 were winning days and 53 total days. 33 were winning days and 20 were losing days, despite the fact that the win rate was only 34%. The average daily gain is bigger than the average daily loss, and even on losing days, our winning trades are being held 3 times longer than the losers. So we are trying to maximize and push those winning trades for as long as we can. I'm going to introduce you now to a tool that we call the OTG Risk Analyzer, and it is really a desktop psychologist. What this tool is designed to do is very simple. It's designed to allow you to play a couple of what-if scenarios, and then once we play these what-if scenarios, then I'm going to put real statistics, those real statistics, and feed that into this spreadsheet so you can see the power of your controlling your risk and maximizing your reward. All right, so the first thing that we're going to do is we're going to talk about what the default settings here are. There's an initial equity on this account at $50,000. We're going to run 100 total trials. That's the default number. For me, that happens to pan out to be just about a month. I take 4 to 5 trades a day, and that is going to happen to pan out for me to be about 1 month. My average risk per trade on 2 lots, and we're going to use the CL here for just a few moments. We're going to consider this to be the CL, and that is 0.44% of the account. That is $220 risk per trade. Now we factor in commission and slippage at $10 per trade. It's not always $10, and you don't always get slippage, but this is going to account for the vast majority of that idea. And so this is your algorithm to manage your risk. Now, this is kind of where the meat and potatoes of this particular spreadsheet is, but one of the first things I want to do here is I want to talk to you about something that happens a lot, and I run into this a lot in my chat room. I get people that ask me, what type of trader are you, Jason? Do you take trades off at one at break, take one off at X number of ticks and let one run? Or are you all in or all out? And my answer is I am all in and all out. And so that usually triggers a philosophical discussion, especially with new guests in our room. And one of the things that I always ask this person is, okay, so what do you take one off at? And if it's on the CL, invariably what happens is someone tells me they take one of these lots off at 10 ticks. I say, okay, that's great. What's your stop? The stop is about where you are, Jason. I'm about 11 or 12 ticks. So for the sake of this discussion, we use 11 ticks. And then I ask the question that really most people don't know the answer to. On average, where does your second lot go off at? Where does that second lot go off at? And most people say, well, I'm not really sure, but 20 ticks. Okay, so let's dig into that, right? And so then by the time we get all said and done and they don't realize, oh yeah, there was a lot of break evens and a lot of break even plus ones on that second contract, what happens is that most of the time that second lot goes off on average somewhere between 5 to 7 ticks on average. So for the sake of this discussion, we're going to use 6 ticks. So if you take the $220 risk, okay, and you divide that by your reward, which is $160, that's a 0.73%. So for everything you're risking, you're going to reward yourself with 73 cents. So for every dollar you risk, you're going to reward yourself with 73 cents. Now, that goes contrary to our discussion that we had earlier for us, which is cut the losers short and let the winners run. In fact, you're doing just the opposite. It's a bit of a paradigm shift, just the opposite, where you are actually cutting the winners short, right? Because you take one off, you're mitigating the winning trade. You're taking one off and letting the other one try to run, and letting the losers run, right? Because you're taking that stop all the way to the full stop. Okay, So let's talk about this particular setup here. So what we've done is we put in the historical trade distribution. And so here's your reward. You're rewarding yourself for 73 cents for every dollar at risk, and you're winning 62% of your trades. Not bad, right? 62% and a 38% loser. What this is going to do is this is going to randomly distribute 100 trades based upon these parameters that you put into place. So you're risking $220, and when you win, you're going to win about $160 per trade. So you hit start and you hit run all trials. And so what this is going to do is spit out for you what happens, right? So it says your number of profits in win percentage, your ratio was 60%. So you had a 60% winning ratio during this random distribution, yet you still lost $297 after commissions, etc., right? So you won 60% of your trades at that win ratio, and you lost $297. Okay, well, that's kind of a bummer. So let's run it again. All right, this time, let's see if we can come up with a different result. So again, this is going to randomly distribute what mathematically can happen over the course of your 100 trades. This time, you actually had a win rate of 66%, pretty good win rate, right? 66%, and this time you won $2,028 is what you could expect at a 66% win rate at that ratio. Not bad, right? That's not too bad. $2,000 on 2 lots, that's not terrible. Okay, so we're gonna hit reset, we're gonna hit start, and we're gonna run all trials here again. We're gonna do it one more time just to see how this thing spreads out. And this time you had a 57% win rate, and you lost $1,400, okay? $1,423. Now, why is it 66% once and 60% another time? Because that's how trading works, right? Trading works in that way. If you have an average of 62% over the course of a year, some months are going to be better and some months are going to be less than that. But overall, over the course of running this thing 3 times, you're up about, give or take a few bucks, you're up about $500, okay? And that's at a win rate of 60, sorry, that was at a win rate, an average of 62%. All right. I know this is a lot of numbers, so bear with me here. So let's go back over here to what we talked about. We said that I was winning 35% of my trades, okay? So we're going to put that in there, winning 35% of my trades at a 2.2 to 1 risk reward, okay? And the break-even trades was 16 and 49. So it was 16% break-even and 49% losing trades, okay? So there's 49%. And here's 16%. All right, that's gets you to 100, and I'm at 2.2 to 1 risk reward at 35%. We're going to hit start, and we're going to run all trials and see what happens here. All right, this time with a win ratio of 43%. Okay, a 43% win ratio, just because my risk reward was 3 times better, then your expectation is for $10,700 in your risk analyzer. So think about that for a second. $10,700 on your risk analyzer just at 43% win rate because you have a 2 to 1 risk reward. We're going to hit reset, we're going to hit start, and we're going to run these trials again. And this time it's a profit of $62.39 at a 36% win rate. Okay, that's what you could expect given proper money management techniques. Now, here's the key to this. Okay, do you remember I told you earlier that as traders, when your system starts to lose and things start to happen, you have 2 or 3 bad days in a row, and things just aren't going the way that you would like them to go, right? That we all as traders begin to want to tweak and manage the system. So that last run right here that I'm showing you was $62.39, $6,000 on 2 lots of risk, risky $220 per trade. Look right here, okay? This is trade 22 down to 43. That's 21 trades, okay? 21 trades over the course. Remember, I told you I'd trade about 4 or 5 times a day. So that's about 4 trades, okay? That's about 4 trades. And in that 4 trades, not 4 trades, 4, let's see, 21, 23, it's about 5 trading days. It's about a trading week. this thing shows you that you won 3 times. 3 divided by 21 is a win percentage of 14%. Okay, so if this is day 1 in my day trading chat room and you see me go on a run like this, then the first thing you say is, this guy can't trade, he's terrible, right? But what you don't know is that statistically, I am going to play this thing out based on my track record for $6,200 on 3 lots. Okay, 2 lots rather. Sorry, 2 lots. $6,300, $6,239 on 2 lots. Also, if you bought the system here, let's say you bought it right up here because you saw this run right here where you had 7 winning trades. Sorry, 7 trades. 6 of those were winners. The winning ratio was 86%. This is the best thing since sliced bread, right? You say, this is the best thing since sliced bread. But then it goes through the inevitable period here, right here, and you go, okay, well, it's broken. I knew it. I shouldn't have purchased it. It's just, it's trash. It's just not what I thought it should be. And so you start to add, tweak, modify, and manage the system to try to fit it back into what it did up there, when this is just the inevitable period of drawdown that goes on. Our statistical edge is to cut the losers short and let the winners run. That's our strategy to get to this statistical edge. We know that in the long run, this is where you are going to be the most successful, is if you have a good high risk reward ratio, right? If you just look at this run right here, you may have given up on the system from trade 27. Actually, you come back up here to trade 22 to 54. That's 32 trades where you only won 6 of them. 6 divided by, what did we say, 34, 32 trades. That's a win ratio of 18%. It's right in this window of 2-week period here where you may have quit the system and moved on because you didn't understand that just around the corner is $6,200 because of your win rate and the way that you're managing your risk to your reward. All right, so that's our statistical edge. I just showed you step number 2 here, trading strategy. The Oil Trading Group strategy to achieving your statistical edge is about leveraging your risk to reward ratio. The number 1 job, again, of a professional trader is not winning, but rather about preserving capital. And George Soros, who everyone here knows that name, said it's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong. All right, so here's a quick trading test. The trade on the left and the trade on the right, those purple dots. Which one's the winner and which one's the loser? And the answer is we don't know, right? The answer is simply we don't know. And as day traders, we don't know the difference between a winning trade and a losing trade before price hits your target or your stop. And despite the fact, despite whatever your probabilities tell you, you're back testing, forward testing, real world simulator, it doesn't matter. The moment you enter into a trade, one of 2 things happen. It's wins or it doesn't. It's that simple, right? It's no more difficult than that. It's either going to win or it isn't, right? And so break-even trades are technically losers because there's fees and commissions and those kinds of things. So really it falls into, regardless of what the statistical probabilities that you've dealt with all along, it either is going to win or it isn't going to win. And so the only thing that you know going into it is how much you're willing to lose. And when the trade starts to work in your favor, then you try to maximize it for all that you can get out of it. And we're going to talk about that here again in just a minute. Understanding risk is important because it's the only thing that you can control once you've entered into a trade, right? And so one of the things that we talk about a lot is that you can't, most of us as traders, we're type A personalities, right? We've been successful in some other endeavor in our life to be able to have some capital to be able to trade with, right? And so we all are type A personalities, meaning that if there's a problem, I'm going to fix it, right? If in your job, if you're a doctor, an engineer, especially engineers, if you're a doctor, an engineer, an airline pilot, an executive, whatever your role or function was in your previous life before trading, once you got into a problem, owned a business, entrepreneur, you fixed the problem. Well, you can't fix the market. The market will fix you, right? We all know that. We've all had that experience. You can't fix the market. So the only thing that you can control is how much you're willing to risk. So again, you can, if you're risking only 1% of your account per trade, then you can have 100 losing trades before you blow it up. And if you're risking 10% of your account, then you can have 10 trades. Again, this doesn't include commissions, but you get the idea, right? So minimizing the risk as much as possible is like the most important thing that we as traders can do. What is the importance of a good rate of return? With a risk reward ratio of 2.5 to 1, your win rate only needs to be 28% in order to be successful. Let that sink in. Isn't that a much better proposition to say, you know what? I don't have to be right 50, 60, 70% of the time. If I've got the right risk reward ratio in my mind and I've got the ability to do that, then I have comfort knowing that I can be wrong a lot and still be right. I could be wrong a lot and still be okay. And that's an important thing when you're trading. That gives you the confidence to move on and move forward, because you know that you're going to be wrong, but when you're right, it's going to erase all of the problems that you've had in prior trades and days. Many retail traders go through the problem of small win, small win, small win, big losing day, right? With this model and your statistical edge being managing your risk reward, you go losing day, losing day, losing day, huge winning day, and it erases all of those problems, right? And that's really the key to our statistical edge. All right, so we talked about Holy Grail, and I know we all rolled our eyes at the beginning of this presentation when we said there is a Holy Grail in trading, and there really is one Holy Grail in trading, and that is managing your risk reward. Your equity growth is a function of your win rate, your position sizing, and how you manage your risk reward. So if things aren't going for you, reduce your risk. If you're in a winning trade, maximize it for what you can and get as much as you can out of it. And I'm going to show you a couple of tools that we use in order to be able to do that. All right. Step number 3, trading tactics, okay? The tactics, also known as your setup. This is our third step in our process to becoming that successful, consistently successful trader. There are as many trade setups as there are people trading them. All right, so there's that old saying that trading setups are like belly buttons. Everybody's got one, and they all stink, right? That's a joke, but in reality, there are as many trade setups as there are people out there using them, and so this is where everyone's going to deviate off the path. So my son, high school age, plays a pretty decent level of high school baseball, been on a travel team for 10 years, nearly a decade, since he was 8 years old, traveling around the country, playing baseball, doing all these kinds of things. When the bat gets into the hitting zone, everybody needs to be in the same place with the same mindset. But how you get to that hitting zone is different and unique to each individual. Some people lift their legs, some people drop the bat, some people have their elbows, some people wind up differently. But by the time the bat gets into the hitting zone, the successful hitters always have the bat in the hitting zone in the right way. And that's what we're talking about with trading setups. The successful traders can be successful in many, many different ways. There have been people presenting all kinds of cool stuff here today, giving you all sorts of different perspectives on trading setups. But when the bat gets into the hitting zone, when you step into the plate and you're getting ready to trade, and once you're in that trade, it's a 50-50 proposition. You manage your risk and you maximize your reward, right? If the number one job of a professional trader is to preserve capital, then the number one purpose of a trade setup is to offer a stop loss location that limits your trading risk. Okay, let that sink in. Your number one job of a trading setup is not to make money. The number one job of a trading setup is to offer a stop loss location that limits your trading risk, because our number one job, after all, is to preserve as much capital as we can. There are 3 basic entry techniques to setups. Obviously, there's fades, breakouts, and reversals, right? And there's an example of all of those. Now, I'm going to show you something here. I'm going to drag this down here in front of you, and I'm going to throw this link into the main chat window here. This is our YouTube channel. And so let me throw this into the main link here. Okay, this is our YouTube channel. And every one of these trade setups that I'm going to show you here were actually taken in our live day trading chat room, and you can find those trade setups here on these videos here. So I just threw you a link to the YouTube channel. But again, you can see that these different trade setups. So this is, I'm about to show you this one on the 8th, the 5th. So these are all on our YouTube channel. You can take a look at those at your leisure. I threw that link into the main window there. All right, so our decision points, support resistance levels, they're broke. Our trading setups are broken down into 3 categories: support resistance, volume and order flow, and price action chart patterns, etc. So I have been very fortunate to have a mentor that traded on the floor of the S&P pits for 30 years. And during his time on the S&P pits, he used a set of support resistance levels that he taught me how to do. And this is something that we teach our room members every day how to do. It is what gives us the ideas to hold on for targets, right? Understanding how to get to a target is imperative. And once you have confidence in knowing how to get to those targets, holding on for an hour long, I showed you that the average winning trade I was holding on to for an hour, right? And so as a day trader with an 11 tick stop, holding on to a trade for an hour is fairly, that's the right term. That is a pretty decent accomplishment to hold on for a trade for an hour with a very small stop or a 2-point stop on the ES. This is a trade that we took on September 8th. And I want you to remember this retracement setup right here. I'm going to talk about this here again in just a few minutes. We got into this retracement setup. The market rallies right up into it, and we were able to hold on for this market structure extension 1 target. It is one of the ideas that we teach you how to do in the trade room. And then there is your trader view screenshot. That's the one that I told you that, right? Our winning trade was 5 times greater than our losing trade. And that's the one there. And if you come here to the YouTube channel that I just threw in for you, you could see that that September 8th trade is right here. I'll go into detail. It's about a 16.5-minute video, and you can take a look at that one as well. Moving on here, September 5th, 132 ticks, same thing, market maker levels, guiding the way with stop location, gives you stop location and potential targets. And then one more time here on September 17th. This is October 17th, 96 ticks. And again, there's just dozens and dozens of these. This presentation's a little bit older, and so I haven't updated it with the most recent, but on Monday of this week, we had 230 ticks on a couple of nice trades in this volatile market. And so we've been beat up a little bit over the last couple of days. But again, when you have a massive, 2,300, 230 tick day, it could make up for losing challenges that go on around that as well. And so again, that's what this is about. It's cut the losers short, let the winners run. And that is our market maker levels. The second thing that we do here is we look at volume and order flow. I have another order flow tool that you see in the day trading chat room that we use. It's a third-party indicator, but we have one as well that looks like this. And so this is a NinjaTrader 7, soon to be NinjaTrader 8, also indicator. And this is a visual graphical representation of where the buyers and sellers are stepping in. What happens to these bars as volume gets pumped into these bars, they get bigger and fatter so that you can visually see where the seller stepped in and where the buyers have stepped in the past, right? So you'll be able to easily identify those buy and sell zones. And this is just a screenshot example of, again, not a very complex tool, right? There's not a lot of, some people don't like, some people love, like I do, I love to look at those numbers inside of the bars. Some people, that's a little intimidating for people. So we've created this really simple tool that allows you to be able to kind of see where the buyers and sellers are stepping in. So you see here that you had this heavier bar, 1-2 heavier bar, pulls back. You get this, you can start to see that the selling pressure, right, this supply zone begins to form, and then you come right up into where the seller stepped in before, and it flushes again. These bigger, heavier bars allow you to see where those things have happened again. Market pulls back up, big heavy bar, took some heavy buying pressure to come back in. You got right to where the sellers started to take over again, and then it flushes out, right? And so again, It just allows you the ability, a simple tool that allows you the ability to find where the buyers and sellers are coming into the market really quickly from a visual perspective. And for me, as a person who runs a trade room that has 150 to 170 people a day show up every day with questions and comments and thoughts and all of these kinds of things, I have really adapted my trading style to a very simplistic approach. And so this is one of those things that helps keep me in line. All right, so final thing here, we talk about price action and price patterns. Of course, there's all of the standard things that people use: Fibonacci, double tops and bottoms, head and shoulders, trend lines, bar closes above and below 50 and 66%, engulfing candles, etc. We use these things every day in the live trade room, and I'm going to show you what we talked about here this morning when we started our analysis today. Okay, so there was a nice cup and handle formation that started. This is the CL that developed back on this was back on the 19th of January, right? There's a cup, there's the handle. And if you measure the distance between the bottom of the cup to the top of the handle, then you basically had that measured move that we missed by just a few ticks. You have a 1, 2, 3 layered top. So you have a triple top here, high, lower, high, lower, high. You have a nice M formation. This is the distance here between the high of the first peak, and it's the highest peak, down into the area where it retraced to, right before you got this move here. The distance between here and there, okay, the distance between here and there is a measured move that we said once this breaks this measured move area, then this is going to be an area that you'll be targeting. And you'll notice today that once it came right down into this area, it got down just below the box and rallied from 44 up to 61.37. That's nearly $1 rally before it subsequently has rolled back over again. Now, when you measure this particular formation, the 1.27% extension of this formation is where you bounced, got the rally into, this was yesterday's sell-off. And oh, by the way, this box right up here, on the CL specifically, this doesn't work in any other place but the CL. The highs or lows for the week get made on Monday or Tuesday on the CL. Sometimes you get both the high and the low, and as it consolidates, but about 99.5% of the time, the high or low for the week gets made on a Monday or Tuesday here on the CL. And so we had some pretty decent confirmation that you had a nice high in here on Monday. You had a trend line break here. You had this consolidation triangle. We rallied up into 62.09, and then this measured move from this triangle, which was here, right? We on the breakout down below, it gets you right back into that zone that we had identified. And again, that's right into your measured move of this particular swing point here of this cup and handle formation. And at the end of the day, it's just, that's how you hold on for targets, is you identify these places in your formations that makes sense. And that's something that we talked about in the trading room this morning. All right, so it is 15 minutes. I've got about 15 minutes left here. I want to make you just one quick offer. For $47, I'm going to give you an extended trial in our day trading chat room. You're going to get 5 days. But in addition to that, I'm going to give you that spreadsheet, that risk analyzer spreadsheet that I just showed you, right, that I ran all those numbers through. I'm going to give you that. Also going to give you one of my favorite trading setups that I showed you. Remember I told you back on that chart that retracement setup that we went right up into, and I think it rolled over for 170 ticks. That trading setup is going to also be included in this package for $47. I'm also, like I said, going to give you 5 days in the live day trading chat room, along with 5 days of CL and ES trade plans for what we do. So the link is oiltradinggroup.com/OTO3, stands for one-time offer, OTO3. You click on that link, there'll be a better and more in-depth explanation of what it is that you receive. In fact, I can just give it to you really quickly here. Let's just take a look at it really quickly, and then I'll go through and answer some of the questions. Give me 1 second here. And this is what that page looks like, right? So this is the $47 offer. We're going to give you lots of information There's Paul Tudor Jones, who says that he has a 5-to-1 risk reward is what he looks for as a risk reward. We talk about the market maker levels, the risk analyzer spreadsheet. There's a video that goes along with it. There's also some training. And then if you click this link, that will take you to a PayPal page and then I will email you all of your content. And once you get your content, it gives you links to the day trading chat room. So, all right, so 13 minutes here. Let me see if I can get some of these questions here from you. That's it. I don't really have many questions here. I was hoping you could talk about the flip, U-turn, and transition today. I'm not sure that's me. You know what? I don't see many questions. If you have a question in here, let me know. Otherwise, unless I get additional questions, then we will wrap it up. I know it's been there's been 6 presenters in here today, and I know it's been a long day. So again, I appreciate you sticking around for me here today as being the last guy. And hopefully that makes sense. So again, very simplistic approach. We talk about this in our trading room all of the time. Trading is not a difficult thing. What makes it difficult is what goes on between our ears, right? That's the thing that makes it really difficult. And I know when I signed on here today that there was someone talking about that very thing, specifically about the psychology and the approach, et cetera. And so again, I believe in that 100%. And so with simple tools and a simple approach, you can do some really outstanding